The economic development of a nation has always involved each of its citizens, and if the majority of citizens are financially healthy, the economic health of the country is also healthy. It does not matter if a citizen is a thrifty or a big spender, the economy of the nation will gain from his or her contribution. These days, however, people have barely enough or no savings at all thanks to the left and right downsizing, commodity prices going high, and other effects arising from the economic slump. An average citizen's financial growth is indeed affected by these factors. Lots of citizens have little or no choice but to take out loans to supplement their needs, but the lack of ability to pay them is a realism a lot of individuals come across these days. Having a good credit rating and property in the UK allow a citizen to get hold of the necessary finances from numerous lending institutions and banks. In the UK, personal loans are a common form of loan for a lot of people needing funds. 1 month to 3 years term of such loans are the often duration which is considered short term in the financial industry. On the other hand, borrowers are allowed to increase the length of their repayment term with special arrangements with their lenders. All of the terms and conditions, including the loan term and the interest rate, should be written down clearly on paper before it is signed. In any loan application, seeking counsel from a trustworthy financial expert is strongly recommended. The kind of policy the loan will have will differ if it is either a secured loan or unsecured loan. If the terms and conditions of the loan borrowed has a longer payment term and lower interest rate, chances are it is a secured loan, but the catch is the property of the borrower is on the line. Borrowers often make their homes as the collateral and they will lose their home if they fail to pay, so thorough planning is very essential before acquiring a secured personal loan. Borrowers have less to lose when it comes to unsecured loans, seeing as a collateral is not required. Since there is no collateral, the burdens of this loan includes a shorter payment term and much higher interest rate than secured loans. The reason why loans that are unsecured have a heftier monthly payment and interest rate is because there is more at stake on the lender's part, which is in contrast to secured loans. Lenders granting unsecured loans have practically no form of guarantee that will compensate them in case of defaults. What makes these two forms of loan same in certain ways is that they are required to be repaid on a monthly basis, which include interest until the term ends and the full amount paid. The repayment setup is often known as equated monthly installments (EMI), and its sum is the only amount the borrower has to pay. The borrower can then use the money to pay for the expenditure that needs to be compensated.